Pretty big news overnight with China taking extra measures to support its economy. Then today we missed consumer confidence pretty big. So a couple things to think about here. And a look at the risk radar as stocks continue to grind and make new highs. The green light holds as the S&P is really carrying us right now. But today's bounce in Nvidia is really important too, as I've spent the last couple of sessions emphasizing the underperformance of semiconductors in Nvidia. That stock back above 120 is very good. Does kind of bring up the potential of a melt-up possibility in stocks if Nvidia can hold there and if it can extend to its sector where we're looking for semiconductors to make a higher high compared to the summer. That's basically Micron's job on Thursday after earnings tomorrow. So we'll revisit the chip chat later on. Let's talk about China for a second. I think generally the best way to think about China cutting rates is as it's an additive to the bull case for U.S. stocks already. There's definitely some potential to push back on that. Obviously, that literally comes from the inflation point. The argument being that if China gets back on its feet and really starts growing, or at least stops shrinking and being basically downtrodden by its own government. It has been a bad few years for China stocks. The FXI in the white, I'll call this the post-COVID period over the last 3 years. So the idea is that if this chart's really turning around and China's actually on a trajectory higher for growth, which technically kind of looks like FXI is in pretty good shape. We got the higher high in the FXI, we got the double bottom there. But here's the thing, it actually hasn't been that correlated to commodities. The GSG commodity index there, keep in mind that coming out of COVID, China was doing terrible. They were stuck in COVID. They were going after all their publicly traded companies. Commodity prices just kept going higher while the FXI was crashing. Then we've had moments back and forth where just the correlation doesn't line up. So in theory, it certainly makes sense that if China's doing better and demands a lot of commodities, that should lift some of the inflationary inputs. But I think the best way to consider right now is limiting to the downside. And that is much better than this idea that they're going to awaken a reflationary risk. It's possible, but let's see if the evidence adds up first. The GSG commodity index still has been at best sideways trending. Crude oil has been downtrending. If WTI, crude oil, really starts moving again, then sure, as we saw the chart earlier from KG, 10-year and crude definitely have a relationship. We'll have that conversation then. Right now, FXI likely just means that you've got another central bank that's looking to support risk assets, and so that doesn't hurt, especially because we've got some major companies here that get sales from China. Apple, Tesla, obviously. So their economy firming up, probably a net positive right now. Here's what else I'm watching in the short term. 10-year yield. Look at the 5-day chart. Today we continue to see the push back and forth, which is why I've had the yellow light on bonds and the dollar. Even though the dollar looks like it's about to break down again, it's held on. So yields, though, if we start going lower, for whatever reason, maybe it's jobless claims or whatever information from the data and the economy the next 2 days, if that causes bonds to rally more, then I get a little bit worried about the stock strength because I maintain, again, that stocks want to see yields going higher. Today, we ended near the highs, at the highs with stocks, despite yields coming down. To me, that's a little bit of tension that needs to be resolved. Still think stocks want yields up. So the fact that we're back to yesterday's low in the 10-year yield, if it goes lower from here, then maybe starts to be an issue. Finally, Bitcoin and crypto, especially next to gold. The red light's on crypto still until we get a meaningful higher high. We're trying to get like a 5-day high in Bitcoin, but let's get a day to hold above 66, 67 or so to get above the summer high. And then the yellow light goes on for a BTC. Gold just looks unstoppable right now. But here's where it comes back to the melt-up potential for risk assets. Gold and Bitcoin have proven to do vastly different things here over the last 6 months. You put in Bitcoin if you want to take on more risk. You put in gold if you want to be a little bit more secure. And so the fact that they're both now trying to break out after the Fed, that's kind of your standard, like buy everything FOMO style stuff when gold and Bitcoin, polar opposites, rally together. If that continues, then it looks like there's real melt-up potential for risk assets. Don't think you need to worry too much about the China reflation stuff now unless crude oil really starts to take off. But if bonds start rallying for the rest of this week, then I would be a little bit more concerned about the potential for stocks to ramp up. Nvidia, 120, good day. Progress for bulls for sure. See you tomorrow.